So it's that time of year again where I do another portfolio update. This time around I'm 34 years old and I plan to do these every single year as the portfolio grows. I mean, whether it's a celebration or not, I'm not quite so sure. Maybe I will end up removing the age off this to make me feel a bit better, but we'll see how that goes. Remember, the whole idea of this is me to show you my entire portfolio, to be as transparent as possible and show you what it's like to build a portfolio from zero right up to my eventual goal, which is hopefully going to be around $1 million. And I do plan to do this every single year, so do stay tuned because I think it's going to be really interesting. Because I'm doing it every year, we're able to see how I am progressing. So if we take a look how I was doing aged 33, that was on my 33rd birthday, my total portfolio looked a little something like this. So I had 1,100 in general investment account over on free trade, I had 4,300 in my lifetime ISA, Vanguard was 43,000 and my free trade was 101,000. So in total I had £149,934 in my portfolio. Now you will see some changes this year because a lot of my accounts have swapped around, a couple are the same and I still have them. So what I'm going to do is take you through all of my investment accounts and I'm going to start with the smallest up to the largest and we'll total them all up and see how we're doing. There may be a couple of big surprises, but don't worry. What I will do is link all of these down below so you can see exactly what I've got and how much is in each. Okay, so let's start off small and get a couple of the smaller accounts out of the way first. One of my newest accounts and one of the new kids on the block is Webull. Now I have a very small account with Webull. I have £193 in there, which is mostly made up of the free shares I received from their very generous offer. Now the reason I have an account with Webull is it is a general account, but they do hopefully have an ISA and UK stocks coming soon, so I'm staying tuned to see what happens. But in the meantime, what I am doing is using their market tools. So I have a watch list set up with stocks I'm interested in, and I can just go into one and I can take a look at the analysis and I can see whether it's a good buy or not. I can also take a look at things like news, or I can quickly grab the company details. This is really handy because it kind of gives me the same features as some paid tools I have, but for free, so it's really good. They also have some cool features like lots of different buying options which you won't see on other apps. You can see within there my free shares are within Apple. I'll hold on to them and just see how things pan out. So that kicks off our total with £193.31. Next up we have my account over on Trading 212. Again, this is a general investment account. This account may seem a little bit more familiar as it was used in my 0 to 10k Trading 212 portfolio series. Now you'll have to bear with me a bit because this is quite interesting. So I started buying UK stocks, which I plan to hold to 3 to 5 years. And I've done that now right up to £1,000. So if we take a look, the current balance is £951. That is going to take some time to actually pay off. The other part of that portfolio is made up of free stocks I've been given. So I do have this growth section of the portfolio, which is very high growth stocks, which include your likes of Apple, Microsoft, Amazon, Tesla, Meta, and Alphabet. And you can see all of them have actually done pretty well. Most are up 5 to around 15%. When you compare the two side by side, you can see that growth stocks are really outperforming these UK valued companies. And honestly, the majority of that portfolio is also made up with free stocks. So all of this collection here, we've got Adidas, some Airbus, we've got even more down here, we've got some BMW, BP, all of this is pretty much just made up of free stocks, which is pretty cool to see. I've also had some dividends from the account. I've had £15.70 in dividends so far. Wow, that's pretty exciting. But that's just generally due to the amount that I have invested in dividend-based stocks. So my total for that account is actually £4,566.52. The reason it's different from the portfolio is that I do have a portion of it held in cash where I'm getting interest on the cash. The rest I've pretty much left in the free stocks as well as those ones I bought. This one's a bit of a weird one and I'm not particularly sure what I want to do with it. Originally my plan was to do the 0 to 10k series, but honestly not enough people are really watching that series. I put that to a poll and asked you guys why. The majority seem to be that they're more interested in index funds and the general stock market news, which is completely fair enough. If you don't buy stocks, maybe it's not that interesting to follow. And the second biggest reason was people are more interested in dividend-based stocks. So maybe I will switch over to a dividend portfolio and do it that way and see what you guys think of that. But of course, the problem is not everybody's going to be interested in dividends. So it is tricky. And the reason I kind of came across this is because it was getting about 6% of viewers were actually returning to watch the series. Now, while I still find it interesting to make and would like to continue, the problem is what YouTube does is look at it and says, okay, only 6% of your viewers are actually interested in watching your content. Let's not show your channel to more people. So actually by making the series, I would be essentially just shooting myself in the foot. So really I have to focus on the content that people want to see time and time again. So I'm not sure whether that will shift to a dividend series or I will put it just within maybe my Patreon account. I'm not sure if people want to see that. Or alternatively, I might just cash in all of these smaller accounts and use them into my lifetime ISA and my ISA, which would be quite handy this year. And it also helps keep my number of accounts down. And remember, of course, I'm not suggesting you have multiple accounts everywhere like me. I've got quite a lot, I would say, compared to a normal person. But remember, I also review all of the platforms every year, so I tend to have an account on all of these different platforms anyway. Surprisingly, I actually have more than this, but I decided not to include the ones where I've only got less than £100 in them. If we add this to the balance, that takes our total to £4,760.87. Okay, so next up is onto another general investment account, and this one is over on Freetrade. Now you're probably wondering what happened with my ISA. I have actually moved that and I will show you in a minute, but I still have this general investment account. The reason for this being this is where one of my lovely Russian ETFs is, which has completely gone. So this one I have HRUB, and that is MSCI Russia. And you can see it's down 70%, which is not really ideal. So that is where the majority of that big loss I had still sits. Apparently its current value is 7,487, but to be honest, that could go to zero. All I can do with this account is sit and wait and just see what happens after the Russian war is hopefully over. Hopefully the market will reopen. I know some Russian stocks are actually still doing pretty damn well, so hopefully that will give me some money back at some point in the future. It might be 10, might be 20 years, but at this point I'm kind of writing it off as a loss, but hey ho, it's still showing us on my balance. So at some point I have to recognize that I may lose that money. I also have within here what I received is a lot of free shares. This was when I was sharing a free link to Freetrade, and you can see I've just got absolutely loads of them in here. It takes so long to sell them as well, and they're so worthless. I mean, some are like minus 95%. Some, on the other hand, I think have done pretty well. We've got some that are here plus 117%. If only you could have had all of your portfolio in there. But yeah, I do need to sell them at some point, but it just takes a lot of time to go through one by one and actually sell them. So that's the reason I'm still holding on to them. I'm not promoting them anymore, so I'm not getting more free shares, but in the meantime, I'll hold on to them and see what happens. At some point, I will sell and get rid of them. So the balance of that account is £8,374.10. We'll put that in for now, but we just need to remember with the provision that I could lose it in the future. But it's still showing on my balance, so hey, let's hold on to it. It's worth mentioning as well, this was originally in my ISA account, but it's been moved into general investment account. Because that item has been delisted, it can no longer be held within an ISA, which is kind of frustrating. So that brings my total to £13,134.87. Now I know you're probably thinking all of these accounts are general investment accounts, they're not very tax efficient, and trust me, I know. I can still make up to like £3,000 a year and dividend taxed within there, so I'm not too worried about having them accounts right now. As they grow, I'll of course have to sort them out and swap them. Maybe they will just get pushed within an ISA. That would be the easiest option. So let's move on to a more tax efficient account. And this is one of my favorite accounts, although it's still, I would say, pretty small. And this is my lifetime ISA. Now the lifetime ISA options are pretty limited. A lot of the other providers, especially the low-cost ones, don't want to do it, and honestly the real reason is it takes a lot of paperwork. It's a lot more hassle, and the total amount you tend to have in there doesn't really make it worth their time and what they're actually making. Hopefully we will start to see more providers start to offer this, but I do think it's up in the air what's going to happen with the lifetime ISAs, and they may even be scrapped, but we will have to see. For the meantime, I choose Hargreaves Lansdown, and I have got a mutual fund in it, which you might be quite surprised at. So this is the one I own. I own the HSBC FTSE All World Index, and I have £11,282.57, which is currently up £906 or 8.74%. So it's actually done pretty well. Now the reason I have gone for this one is it's a nice diversified world fund. You can see it's broken down across a lot of different sectors, and it's also broken down across a range of different countries. It's very similar to any kind of world index fund you would find. But the reason I've chose this fund is my charges for the fund, so this is relatively low cost. If I go into a detailed breakdown, you can see my management charge is 0.45%, but this is uncapped, so this is where it gets a little bit sketchy. So for this one first, my management charge is 0.45%, which is £22.99 for the year, and the cost for the fund is 0.13%, so I'm paying £6.65. So in total, my charges for the year are £30.24. which is pretty good. Now, the reason I'm doing it this way is I could do it as an ETF version over on Hargreaves Lansdown, but what happens is you need to buy the ETF each time, which is treated as a stock. You can buy them, which would cost you, I think roughly off the top of my head, is about $11.99, or you can go in and pay the regular investing service, which is £1.50 per month. But because I've got the fund in this version, I don't have to pay any fees to buy more at any point in time. So if I want to chuck £100 in, there's no fees. £50, no fees. So it's quite simple. This will change at one moment in time because that fee is uncapped. We've got the two accounts. Maybe the ETF version is kind of like here and this one is here. As that account grows, the cost will kind of catch up and take over it. At that point, it will make sense to swap into the ETF version. But when I've done the maths, I can actually hold this to around £30,000 or £40,000 before that even comes an issue. And remember, I can only add in £4,000 for the year, but I will get a government bonus of £1,000. And you can see this year I paid in £800, so I have £3,200 remaining that I can add before the end of the tax year. This account is actually my top priority to pay into first because it gives me the biggest bonus out of any of my accounts, which may surprise you because you think, oh, let's put in an ISA, but actually the lifetime ISA is better to put it in as long as you're willing to take that money out when you're 60. I use it for retirement, which not a lot of people do. They use it for a property, so it does get overlooked, and that is a problem with a lifetime ISA, where it's actually very important. And that takes us to a total of £24,602.56. So now we're getting into the proper numbers. So now we'll have to hop onto the desktop to take a look at Vanguard, because unfortunately, they don't have an app. And this is my pension account. So let's take a look at how this one has been doing. Okay, so this account you may recognize from my 0 to 100k series. This account is a pension account and basically it's my pension. And what I've done with this is invest 100% of all of the money I've earned from YouTube straight into this account. So I think it's so interesting to do. So we're currently on our way to 100k. We don't know when we're going to hit it, but let's see how we've been doing so far. So the balance is currently £69,962.70. And luckily the stock market has been doing pretty well over the past month, so let's see how that's been performing. So within here we've got two funds. We've got the FTSE Developed World Fund, which is VEVE. This is 81% of my portfolio, cost me just under £55,000 and is currently worth £57,000. Secondly, I've got this Sterling Short-Term Money Market Fund. This is just where I store cash, which gives me some interest on my cash while I'm waiting to invest it. Realistically, I should have took the leap and just put this straight into my other fund I want to buy in here, which is emerging markets. I haven't got around to doing that yet, but I still need to add some more cash, so I will be trying to do that shortly. The reason I left it at this is because I know Warren Buffett has 14% of cash in his portfolio, and I thought, oh, I've landed on 14%. That's pretty cool. I'm basically Warren Buffett now. Not really. Okay, so the performance of that one, this is what I think is really interesting. So you can see that is how much I've contributed, and I've returned 4,130 in the time I've been investing. So this is really nice to see. And it shows my rate of return has now been 9%. But what's really good to see, if you look at this, and this is why I think investing on a regular basis is so important, you can see my balance has just gone up and up and up and up and up and up and up. Now, it doesn't mean the stock market's done that, but it means because I'm adding cash, I don't really see the times it goes down. And this mentally is such a better concept. And if you go into the breakdown of my calculations, you can see my current value of my investments, what I've sold, my interest on them, and you can see my dividends. So I've had £933 in dividends, which is pretty impressive. And my charges for the account have been £102. So in total, my return has been 4,130. If we break this down by month, you can see November has been a particularly good month. October definitely wasn't that great, or September or August, but these big months are really the times where it does pay off. I'm not saying it's going to stay like that by any means, but we'll see how things go. If we go into my investments in more detail, you can see what each has returned to me. So my cash actually has returned a gross return of 8.58%, and my Developed World Fund has returned a total of 17.13%. And that is a gross return. Of course, maybe the capital return is more realistic. But the reason this is showing us so good is this. So if I go into my holdings and I go back and go into this one, you can see my chart. And look how well I managed to time the last buying moment. I bought here and it shot right up, and that's why my portfolio is looking so good at the moment. But of course, I haven't always timed it well. Like I bought it here and it dropped, here and it dropped. But when you draw a line from there right across, you can see it has moved upwards from all of these points. So when you go to buy, you think, like even now I want to buy, and I'm thinking, well, I don't want to buy at the moment because it's gone up. But realistically, it's going to go back down anyway. But eventually, over a long enough period of time, These points, so where I look back here and think, oh, I bought when it was a bit high, actually it doesn't really matter in the long term of things. These will just be small blips on a much longer timeline. Imagine dragging this out by another 10 or 20 years. You'll look back and think, why was I even bothered about buying at that particular moment in time? But of course, in the short term, it does feel good when you buy when it's down and then it shoots up like this. But realistically, I shouldn't even really be looking at this at the moment. Stick the money in and come back in 10 years' time. I only look so much because I am making these videos for you guys. So I've got a couple more months I need to add. I need to add September and October into here and my earnings. I don't know how close I'm going to get to 100,000 by the end of the tax year if I'm being realistic, just off YouTube money. I could put my own money in, but I want to really keep this 100% within YouTube. If we go to my overview, we can see how much I've contributed. So this year I've contributed £9,538, but the current allowance is £60,000. So I'm not going to get anywhere near those numbers realistically. I still need, what, £30,000 by the end of the tax year? September, October, November, December, January, February, March. So that's 7 months. So within 7 months, can I get £30,000 in there? Yes, I get the government boost, but that would be pretty ambitious. Unless I'm able to launch some product that does really well, I'm not going to hit those numbers. But we'll keep going because it is really all about the long game. Okay, so let's add that number to the total. This will really chunk things up. That takes us to £94,565.26. Now, I don't know what I will do with that account. I have this kind of internal dilemma because my next account, which is my ISA, is over on Invest Engine, which we'll jump on now. Now, Invest Engine are opening a SIP, which is going to be hopefully lower cost than Vanguard. So it makes sense for me to move over there and have all of my portfolios in one place. The problem is though, of course, I will lose the historical data that I've got in the past. So that nice chart with all my little buying moments, I will lose. So I'm not sure whether I want to get rid of that, but it would be so nice to have my investments in one place and my total would be really amped up. Let me know what you think about that and what you would do, because I think it's quite an interesting dilemma. For me, I've always wanted to have all of my accounts in one place, and it's kind of frustrating that I'm not able to. Even if I get these across, then I still haven't got my lifetime ISA. The reason I've got this over on Invest Engine, because it is lower fees than Vanguard. I could have kept it on Vanguard, but their fee is slightly higher than what I would have to pay there. I think I have to just pay an extra 0.15%, which isn't a massive amount. It's only kind of a couple of £100, but it does add up over time. So for the sake of that, I might as well be over here. So my return since moving my ISA has been plus 1,171. You can see from the kind of journey of being in here, it has been a little bit rocky. So I did move over and I had this kind of balance right up here before, and then it dropped right down, but now it is coming back up. The disadvantage I have in here is I haven't been adding on a regular basis. And that's because this year, I've had a couple of things going on in my life and I'm trying to buy a house this year. So I'm still debating whether I want to add more money. The issue I've got is I can only put £16,000 per year into this account because I am filling the lifetime ISA. So I kind of think on one end, I want to keep the money back and pay for a house, but I know I can only put 16,000 in and I want to grow this account. So I really kind of need to do that. So that's why I'm thinking about maybe selling the smaller accounts and moving them in here, but I do love watching them individual stocks, so I'm not sure. So within here, I have the two funds that are in my two fund portfolio. So we have the Vanguard FTSE Developed World, which is at 108,000, and we have the Emerging Market Fund, which is 10,215. Now these ones are different to the one over in Vanguard. In Vanguard, I can't hold the accumulation fund. So what that means is it automatically reinvests the dividends I'm paid. So I've got the correct versions on here that I want. It doesn't really make much difference in the long term of things, but this is much easier because it's all hands off. Now you're probably wondering what's the difference between these? Why is this one done well and that one's not done so well? Well, the difference is actually quite simple. So when you come into here, my goal was to try and get these percentages right up to date. So I've done that now. I did have cash. I'm aiming for 90% in that one and 10% in this one. So if we click in, you can see how I have been buying. So I've bought as it dropped down. And again, I bought when the market was down and it has shot up, which has done well. But then if you go into the other one, I decided not to buy in this one. So when it all came down and it shot back up, I didn't buy any more. So the idea is you do need to be averaging into both of these funds equally if you want to see those good returns. And this is how that portfolio is broken down. So you can see it's very broad as a world fund. You've got North America, Europe, Asia, emerging markets, and the UK. And then you've got a small amount in the rest of the world. There's no bonds in my portfolio. I'm 100% in equity because I'm focused on growth. And you can see I am split quite widely over a range of different sectors. And of course, my biggest holdings are made up of all the big growth tech companies. This is what you have to constantly remember because index funds can seem quite boring, but actually they are driven by all of these big companies anyway. What's interesting on here is you can actually see it broken down in much more detail. So if I go into the analytics section, I can see my equities and you can see things like my North America, I've got £69,000, how much I've got in Europe excluding the UK, how much I've got in Japan, Asia, emerging markets and the UK. I mean, I never thought I would have £7,000 invested in Japan, but it's a diversified portfolio. As well as different sectors, you can see how much I've got in industrial, technology, healthcare, £4,000 in mining, not so much in energy, which is quite good. I don't want to be heavily in the energy sector. Technology is kind of where it's at for me, and financial also is pretty good. Interestingly, it also shows me all of my holdings. So I've got 3,989 holdings, which you really wouldn't believe looking on the surface of it when it's just 2 index funds. But this is how many companies I own, like nearly 4,000 companies. And you can see within here, which is quite interesting, I've got 4,000 in Apple, 4,500 in Microsoft. So actually, if you look at it this way, you can feel like you're investing in stocks, but you're doing it in what I would class as kind of the safest way possible, by really diversifying and spreading your risk. I really like how simple and clever Invest Engine is. I don't have any dividend data in there, it's just automatically reinvested. So it just keeps it so simple. You buy your 2 indexes, invest every month, and just keep it as simple as possible. I'll leave a link to Invest Engine down below because they do have a welcome bonus of up to £50 when you sign up, because I definitely recommend this platform to anyone above everything else. So at the moment, I do have in that 119,000. It would be nice to have my SIP in here as well, because imagine I've got that £70,000 on top of this, especially if I keep investing, I could easily grow those to over £200,000 in one account. So at the moment, I do have in that 119,000. It would be nice to have my SIP in here as well, because imagine I've got that £70,000 on top of this, especially if I keep investing, I could easily grow those to over £200,000 in one account. So if we add this to the portfolio, it brings our total to £213,716.72. What's really interesting with this as well, if we look back on where we were before, we can see I've gone up 42.5% since this time last year. So although maybe the stock market returns in the past year haven't been amazing, because you keep adding more cash, grabbing all of those government bonuses as much as you can gain much more money. And remember, this year I haven't really been putting money into my ISA or my lifetime ISA. I think I've put in maybe £800 in total so far, so it's nowhere near where I want to be. So I've got to decide at this point whether I want to be more aggressive and go for the stocks, or maybe I take a little step back and put money into a house. I mean, 43%, if I could do that every year, which I definitely won't be able to do, would be phenomenal. So I hope this has been helpful and sharing these is valuable to you guys. I will think about doing them on a more regular basis. I'm thinking at the moment, once I get over the 0 to 100k, maybe I'll combine it all into one and do a regular, maybe monthly portfolio update. Otherwise, well, maybe if it's better for the YouTube algorithm, let's do them when I hit certain milestones, maybe every 10, 20, £50,000, I'm not sure. What's really good about this, and what it does illustrate to me, and what I was just thinking about this morning, is that actually, yes, I invest and maybe don't spend money on other things, but the thought of now having £215,000 in this portfolio, if the stock market goes up, say, 10% in a year, and admittedly it could go down, well, that's like making £21,000 in a year. And then the next year you're making 24,000, then 26,000, 28,000. So before you know it, you're almost making this big sum of money every year. The problem is though, that is quite addicting, and it's like, when are you actually gonna get to spend that money? But it's so powerful to see and just really demonstrate the power of investing. If you have any questions about any of my accounts, let me know down below. I hope you found this useful, and do subscribe because I plan to keep this series going as long as possible, maybe even right up to 1 million. Hopefully, let's see how far we can get. Thanks for watching, and if you want to see more about my fund strategy and why I'm buying these 2 index funds, check out this video right here where I cover it all. Thanks for watching, and I'll see you over there.